For those of us leading non-profits, you probably inherited a chart of accounts, or maybe someone before you set it up. Maybe it was an auditor, maybe it was a bookkeeper who was learning on the job, or maybe actually you are the one setting it up yourself, but in the process you've missed out on the big questions that you needed to address, and now it's yours and it doesn't quite fit. So you're pulling reports that don't tell leadership what they actually need to know. You are doing gymnastics at the grant reporting time, formatting numbers that should actually been structured correctly from the start. And at audit time, it even becomes more gymnastics because you're manually reconciling things that should just really work. So it's always important to remember that the chart of accounts and your accounting dimensions are not an accounting problem. It's a strategy problem. Because you see, the way you code your transactions today determines whether your organization can really demonstrate program impact tomorrow. And I know this because I've walked this journey. This will actually determine whether you can justify overheads to a major donor at a click. It also actually determines whether your board can make a real decision in a finance committee meeting, because it boils down to the quality of reports that you're sharing with them. And this one, it also determines whether once you give people reports, they are just nodding at the numbers or they can actually interpret them. So this is pillar one of the firm framework. The financial systems clarity, like I've shared before, the firm framework is a 4-part system. Financial systems clarity, internal processes and compliance. Then we have reporting excellence and multi-year sustainability practices. So in this video, I'm going to walk you through how to redesign a non-profit chart of accounts from ground up, step by step, so that it serves your programs, your donors, and your leadership teams, and not only just your auditor. As always, my name is Rose, and I bring in 2 decades of non-profit sector financial management, and now I'm the author of the firm framework. So let's get into it. Let's start with the story of a broken chart of accounts and accounting dimensions. How does this look in practice? Because, I'd be willing to actually bet that for those of us that are watching, this actually sounds familiar, especially those of us that are leading finance in our various jobs. So the story goes like this. The organization has maybe 3 or 4 programs, but in the revenue section, all income is coded to a single account, program revenue, for example. That's it, full stop, no separation, not just that way. And then on the expense side, you probably find 67, for example, 67 accounts, including office supplies, program A, office supplies, program B, office supplies, admin, office supplies, miscellaneous, 4 separate categories for the same category. So what exactly is going wrong in that example? You see, the revenue side is so aggregated that you cannot tell without a massive manual exercise what any single program brings on board, or what any single funding stream brings on board. And on the expense side, this has been chopped up into a way that it really doesn't map to anything useful. It just maps to whoever was doing the data entry that day and made that judgment call. And this happens to even the best of us. But on the flip side, meanwhile, restricted versus unrestricted revenue cannot be separated. You cannot actually see them. You have no sight. Grant funding from the government, from foundations, these are all sitting in the same account. Multi-year pledges, single-year gifts, all these are just all in the same revenue account. And as a result of all this, every grant report is a reconstruction project. Very, very painful. Every board presentation requires hours of offline analysis. I have been here, so I know what I'm talking about. In every audit involves your team manually building schedules that should have actually generated themselves from your system. And mark you have a system that you're working with. You're not working with a manual system. You're working with an electronic data system. So this is actually what it looks like when a chart of accounts was built for data entry convenience and not for reporting output. And the fix doesn't start with changing the accounting numbers, for example, or the account numbers. It actually starts with asking a different question entirely. Remember how I was saying that probably you are implementing the chart of accounts as a new head of finance and you missed out on the question. So that question is this. Yeah, so the question I was actually talking about is this. Before you dive in, you need to ask yourself, what decision does this organization need to make? And what reports need to exist for those decisions to be made well? Very, very simple, but the biggest question that will help you to get it right. So everything, every account, every segment, every dimension, every structural choice in your designing of your chart of accounts flows from that question. So before we get into the step-by-step process, I want to give you 5 structural principles. These are what I call the design rules. So if your chart of accounts violates any of this, you will have problems downstream. I can bet you for free you will. And you'll spend your work life rebuilding the numbers every time someone asks a question. So let's go into principle number 1 is revenue accounts must reflect your funding infrastructure, not just your income categories. What do I mean? This means that you have to know how to separate foundation grants from government grants, separating multi-year from single-year grants. You know, there are accounts that tracks long-term receivables and short-term receivables. That will be very, very important for you. And also having a dimension that separates temporary restricted funding from unrestricted. Why? Because you know your grant reports, your board treasurer's report, and your auditor's net asset disclosures all require this distinction. If it's not built into your chart of accounts and your dimensions, you're creating it manually every single time. Principle 2 is that the expense accounts should mirror your program structure and not just the functional categories. So, you know, functional categories, for example, for organizations that do the 990, there is the programs, there's the management or admin, and then there is fundraising. So these are all required for those organizations, the US entities that are filling 990. And also for those organizations that follow the IFRS for SMEs or the early adopters of the INPAS, the newly launched international non-profit accounting standard, there is a clear prescription of how to classify expenses per categories. But you know, if you only expense dimension is such that it's only covering this, then you cannot actually report on individual program costs. So you need to have both. You need to have a system that takes both into consideration. And the cleanest way to get both is through a segment or a dimension structure, which I'll explain in the next coming section. So the third principle is that the level of detail in your chart of accounts should match the level of detail in your reporting requirements, not more and also not less. So you see, every account you create is an account someone has to code to correctly every single time that they are doing an entry. So accounts that are too granular also create errors. Then accounts that are too broad also create reconstruction work. So you have to right size the detail of your accounting and reporting obligations so that you can get it right. And then the fourth principle is that natural accounts and dimensions are two different things and they should be used differently. So your natural accounts are the ones that describe the what. the salaries, the rent, the supplies, the professional fees. Your dimensions describe the who and why, which program, which grant, which department. You need to code this natural, the what to. So if you want to try to encode programs and departments inside your natural account numbers, you end up with your 4 office supplies account that I talked about earlier. And this is a very, very common practice. And sometimes maybe it's because of the limitations of the accounting software that you're using. I know some that don't have parameters for creating these as dimensions, and people have reverted to creating them as part of the natural account numbers. It works, but it works to a certain level. So the best practice is to use a class or a dimension field for the who and the why. Then you reserve the account number for the what. That's the best practice. And then principle number 5 is that your chart of accounts should make your 990 or your statutory returns preparations faster and not harder. So these forms often require you to report expenses by function, program service, management, or general fundraising, like I said before. And it also requires specific line items, you see, like the natural salaries, grants to others, depreciation, etc. If your account structure doesn't map cleanly to those lines, your year and close will definitely be painful. So designing the mapping in from the start, not as an afterthought, will go a long way. So the 5 principles I have talked about is designing around this, and then making sure that your chart of accounts will serve you. So if you ignore them, then you are just going to always be rearranging numbers. Now let's get into the process itself. So step 1 is audit your current chart of accounts against your reporting requirements. So what this means is that you pull the 3 things. Pull your most recent, maybe from 990 and all your statutory filing, the one that you use. Pull maybe your last 3 major grant reports and your most recent board finance committee report. For each one of these, ask what data did I have to manually pull or reformat to produce this output. And for every manual step, there is a gap in your chart of accounts design. So document every gap, and that list becomes your redesign belief. So that list becomes what I call your redesign brief. Then step 2, map your programs and funding streams. So list every active program, list every active funding stream by type: government, foundation, individual, and earned income. Those are most of the standard ones. And then list every restricted grants. So now you know how many revenue accounts you actually really need from that listing, and what your dimension structure has to support. So this exercise will alone surface more structural problems than you expect once you have that clarity. Then step 3 is that define your account structure and your numbering logic. Very, very important, because if you don't do this thoughtfully and with longevity in mind, you will actually get stuck at some point. So, like a standard nonprofit structure looks like maybe 1,000 for assets, 2,000 for liabilities, 3,000 for net assets, 4,000 for revenue, 5,000 for maybe personnel expenses, 6,000 for program expenses, 7,000 for general or administrative expenses, and 8,000 for fundraising. I'm using that because it's almost like the standard how generic accounting systems usually come. So, but what you need to do is that you need to give yourself room to grow. Don't use sequential numbers with no gaps. Inside each range, group logically. All compensation, for example, you can decide that these are going to be between 5,000 and 5099. All benefits in 5100 to 5199. So this makes your statements readable without needing to have a translation guide. Then step 4, design your class, segment, or dimension structure. So if your accounting system supports classes like I know QuickBooks does, maybe Sage, Impact, NetSuite, they all do. And I also know that Microsoft Business Central has global dimensions that you can work with in this aspect. So you use them for program and grant tracking rather than creating parallel account codes. For example, a class called Program A applied to a salary account gives you a clean program profit and loss without cluttering your natural account list. So if your system doesn't support classes, you will need to build program segment or program dimension into the account number itself. Maybe a 4-digit natural account plus a 2-digit program suffix that allows you to do that. It's more rigid, but it works. The key is that the segmentation logic is intentional and documented. And for the last part is especially for the people who use QuickBooks and don't have space for additional dimensions that they can use. So step 5 is test the new structure against your output reports before you finalize it. This step is non-negotiable. It's just like when you are going live with a new system. You must take your draft chart of accounts and dimension and trace through every report that you produce. Your statutories, your standard grant reporting template. Hopefully, InPass will help us to reduce the number of grant templates that we have to use going forward when people finally adopt it. Your board dashboard, for example. If the roll-ups don't produce those reports cleanly, revise the structure. Do not go live with a chart of accounts or a dimension structure that you haven't tested against your actual output. And I am sharing this from lived experience. So step 6, plan the transition. For example, if you are media, you need a reclassification plan. Work with your auditors if possible. Document what moved and why, and maintain a crosswalk from old accounts to new accounts. You'll need it for multi-year trend analysis and for anyone pulling historical comparisons. If you are doing this at fiscal year start, that's much cleaner. That's the most recommended. Build the new structure, enter beginning balances from the prior year audit, and start day 1 on your new fiscal year with clean infrastructure. 6 steps, and that's the process. So here is what I want you to walk away with from this video. Your chart of accounts is a strategic infrastructure decision. Every account you create or fail to create shapes what information your organization can produce and how quickly you can produce it. A poorly structured chart of accounts doesn't just make your accounting harder. It limits your ability to demonstrate program impact to funders. It slows your leadership decision making, and it adds hours to every audit, every grant report, every board meeting. The cost is real. It just doesn't show up as a line item like I have shared before. And I want you to remember that a well-designed chart of accounts actually does the opposite. It makes the numbers speak clearly. It turns reporting from a reconstruction project into a clean export. It means your finance team is spending their time on analysis and not on translations. So the 6 steps I have walked you through today: audit your current state, map your programs and funding structure, define your structure, design your segments, test against the output, and then plan your transition. That is the process, and it works, and it applies regardless of your budget size, your accounting system, or how long the broken version has been in place. If this is useful to you, subscribe, because I publish every week on non-profit financial leadership and systems infrastructure. I will see you in the next one, and thank you for watching. This is the Farm Framework.